Today I'm going to tell you about a robbery operation. They have marble counters, suit-wearing employees, your trusted partner written in their windows, and every year they quietly take money out of millions of people's pockets. But this taking doesn't happen at gunpoint. It happens through fine print footnotes, asterisks, and very carefully chosen words. Today I'm going to tell you exactly how your bank works, what traps it sets, and how to avoid those traps. When you finish watching this video, you will never look at banking institutions the same way again. If this kind of content interests you, subscribe now and turn on the bell, because this is just the beginning. Now let's set the scene. The year is 2026 and banks are living through the greatest era of deception in their history. Every ad says free, high interest, no commission. We're here for you. But look carefully at the fine print beneath that ad, that gray 6-point footnote. Do you see it? That's when you start to understand. The bank is not your partner. The bank is a business that wins when you lose. Every customer-friendly feature is built around a single question. How do we extract more money from this customer while making them feel good about it? They've been playing this game for 100 years, and today I'm going to show you the entire playbook. 9 chapters, 9 deceptions. We start with the smallest and end with one where the average homeowner loses hundreds of thousands of dollars over a lifetime, most of the time without realizing the transaction even took place. Chapter 1. The smallest lie, the word printed on the front of every ad. Free. Free account. No monthly fee, no minimum balance. You've seen this on billboards, on bank websites, in commercials between football games. You've seen it while scrolling through social media videos, and almost none of it is true. At most major banks, what a free account actually means is this: free as long as you behave exactly the way we want you to. Maintain a minimum balance of $1,500 per month. Make at least $500 in regular direct deposits every month. Don't request a paper statement. Don't let your account go inactive. Break any one of these rules, just one, and the meter starts running. Major bank account opening documents typically include 40 different fee line items. That document you signed but never read. Here's the math. A customer who violates just one condition, say they couldn't make their direct deposit for 2 months because they changed jobs, pays roughly $144 that year for their free account. Free doesn't mean free. It means free as long as you do everything right. The moment you don't, the bank starts collecting, and they've been waiting for that moment since the day you opened the account. Chapter 2. They won't move you. Right now, go to your bank's website and put 2 products side by side: the standard savings account and the money market account. At major banks, the standard savings account pays 0.01% interest, not 1%, 1/100th of 1%. For $10,000, that's $10 a year. That same bank at the same time offers 4% to 4.5% interest on its money market product. For $10,000, that's $400 a year. Same bank, same amount, 400 times the difference, and the bank knows exactly which account you're sitting in. So why don't they move you? Because the money sitting at 0.01% is the most profitable deposit on their entire balance sheet. They take your money at 0.01%, lend it out as a mortgage at 6 or 7%, and take it back as credit card debt at 24%. The spread in between is their profit. Do the 10-year math. $10,000 at 0.01% becomes $10,010. $10,000 at 4% becomes roughly $14,800. At the same bank, nearly $5,000 is sitting on the table, often accessible with nothing more than a 10-minute online application. The bank has calculated to the penny exactly how much money you're leaving with them. They've decided it's more profitable to let you sit there than to tell you. This is not an oversight. This is the business model. Chapter 3. The rate resets. You've definitely seen this ad. 5% in huge letters, sometimes with a graphic of money raining down. Then the asterisk. 6-point font, gray text. At the bottom of the page no one ever scrolls to. Introductory rate, first 90 days only, valid on balances up to $5,000, then drops to 0.40%. So what does the customer who sees that 5% ad and deposits $5,000 actually earn? Approximately $62 in the first 90 days at 5%. Approximately $15 in the following 9 months at 0.40%. Total $77. The effective annual return on $5,000, 1.5%. Not 5, but the headline said 5, and the headline got the customer in the door and made them transfer their money. The bank has studied this statistically. When the rate drops, the vast majority of customers don't withdraw their money. They stay even when the new rate is far below what they were originally getting. Inertia is the most reliable customer behavior the bank has ever discovered. The entire teaser rate system is built around it. The headline rate is the rate used to bring you inside. Once you're inside, they know you'll stay. The greatest crime scene in history is not hidden inside a bank vault. It is etched into the very fabric of how money breeds in the dark. Throughout history, every major faith and ethical philosophy branded interest, usury, not merely as a financial preference but as a social murder. Ethically, interest is seen as a predator because it turns time and humanity's struggle for survival into a commodity. It creates a parasitic relationship in which the lender earns without taking any risk or expending any labor, while the borrower is shackled under the weight of compounding seconds. The moral argument is simple. Money should be a medium of exchange, not a weapon of exploitation. When you sell time at a price, you sell something that belongs to no mortal, and you effectively place a tax on life itself. The evidence of this moral collapse is not found only in ancient scrolls. It is written into the wreckage of the 2008 subprime mortgage crisis as well. We saw how credit exploitation and interest-based securities evaporated the life savings of millions of people, turning homes into spreadsheets and families into default statistics. From the debt traps of developing nations to the modern student loan crisis, the evidence is undeniable. When money is allowed to breed money without creating value, the result is an ever-widening chasm of inequality that eventually collapses the entire system. In the eyes of history, interest is not merely a percentage. It is a silent assassin that sucks the sweat of the worker's brow to fill the coffers of the idle. So if the system is rigged with interest, what is the way out? In the framework of Islam, the solution is not merely interest-free. The issue is putting your hand under the stone. They introduced a concept that chills modern bankers to the bone: profit and loss partnership. In this world, the financier is not a vulture waiting for you to default, but a partner. If the business goes under, the bank burns with it. This forces money out of the shadows and into the real world of bricks, mortar, and sweat. This is a radical shift from exploitative lending to shared destiny. While the traditional model profits from your failure, this ancient alternative demands your success. Because under this rule, profiting without taking risk is not commerce, it is a robbery. Chapter 4. The order is rigged. This is the most outrageous deception on this list, and most people have never heard of it. Banks reorder your transactions to collect extra fees. Imagine this. You have $250 in your checking account. In the morning, you spend $4 on coffee, $6 on a snack, $8 on parking, a total of $18. Your balance is now $232. Then in the afternoon, a $260 rent payment comes in. With the real order, the math is this. Coffee, snack, parking all go through successfully. Your rent payment pulls your account to negative $28. One overdraft fee, $35. The bank's order is different. The bank processes the largest transaction first. The rent payment goes through first, draining your account. Now the $4 coffee comes in, account is in the negative, overdraft fee. The $6 snack, overdraft fee. The $8 parking, overdraft fee. The same spending, 3 times the fee. $105 instead of $35. This went to court. Banks paid hundreds of millions of dollars in settlements for exactly this practice. And after the settlements, they kept doing it. They just changed the names. They called it high-to-low transaction ordering. They called it transaction sequencing. They wrapped it in a courtesy overdraft protection service that you were enrolled in by default. a service that is one of the most profitable items across the bank's entire product range. They didn't make a mistake. The order was chosen by a system to extract more money from you. The transactions occurred in one order in real life, and the bank chose to process them in a different order because that different order made them more money. If you remember one thing from this video, let it be this. Because once you've seen it, you can never unsee it. Chapter 5. The number is chosen. There is a small trick running quietly through every bank product you'll ever see. When the bank gives you the interest rate on a loan, they give you an annual percentage rate. When the bank gives you the interest rate on a savings account, they give you an annual percentage yield. The rate calculated with compounding always comes out slightly higher. Your credit card says 24% the annual rate, but with daily compounding, what you're actually paying is closer to 27%. The bank chose the smaller-looking number because smaller looks less devastating. Your savings account says 4% annual yield, but the actual interest they're paying behind the scenes is below 4. The bank chose the bigger-looking number because bigger looks more generous. Same bank, same math, two opposite directions. On the loan side, the number looks smaller. On the savings side, the number looks bigger. Neither is a lie. Both were chosen. Every number in every bank product was chosen to make the bank look better in that specific context. The moment you understand this, you stop trusting the headline figure and start asking what the headline is not showing you. Chapter 6. The Hidden Spread. Try sending an international wire transfer through your bank. The visible cost is the wire fee, $40, $50, sometimes more. Nearly all of that fee is pure profit. The actual cost to the bank of processing a wire is under $1. But that's not the deception. The deception isn't what they don't tell you. When money goes abroad, the bank says no foreign exchange commission. That sounds good. But they're not saving you anything. They've moved the cost from a fee you can see to a spread you cannot. The real exchange rate between dollars and euros is set by the global currency market. Anyone can look it up. Your bank doesn't give you the market rate. It gives you a rate that might be 2%, maybe 3% worse. The difference between the real rate and the rate they give you is their profit. A 3% spread on a $10,000 transfer is $300. The bank took an additional $300 from you on top of the wire fee and called it no foreign exchange commission. Technically true, there is no line item anywhere labeled FX commission, but the $300 cost embedded in the exchange rate is written down nowhere. No commission does not mean no cost. It means the cost has been moved somewhere you cannot see it. Chapter 7. Loyalty is a trap. Sooner or later, your bank will make you this offer. Move all your accounts to us and we'll take care of you. Checking, savings, mortgage, credit card, investments, all under one roof. They call it relationship pricing. They call it loyalty rewards. On the surface, it looks attractive. They'll waive your monthly fees, knock a quarter point off your mortgage rate, maybe offer a slightly higher savings rate. The math feels positive, but take a step back and look at what's actually happening. They're offering you small discounts on products that don't make them very much money, things like monthly fees and ATM reimbursements, in exchange for pulling you into their highest margin products. The management fee on the investment fund their advisor recommends is typically 1% or more. An equivalent index fund at a competing brokerage charges 0.04%. On a $100,000 portfolio, that difference is $960 a year, every year, forever. The mortgage discount saves you a few $100s a year. Their in-house investment product costs you nearly $1,000. The math doesn't favor you. It favors them by a factor of 3 or 4. The word loyalty is the trap. They are not rewarding loyalty. They are penalizing comparison because the moment you start comparing, they lose. When a bank offers you a discount to keep everything with them, what they're really saying is, please don't shop around. If you did, we'd lose. Chapter 8. The branch sells, it does not serve. Walk into any major bank branch. Notice the design. Marble counters, glass-walled offices, professionally dressed staff, the word partner somewhere on the signage. You're invited to sit in a chair across from someone with the title Personal Financial Advisor. This place looks like somewhere you go to get help. It is not. It is a sales floor designed to look like somewhere you go to get help. The advisor sitting across from you, at most major retail banks, is a commissioned salesperson, not a fiduciary, which is a legally meaningful distinction. A fiduciary is someone required by law to act in your best interest. The advisor at a bank branch in most cases is held only to a suitability standard. They are required to recommend products that are suitable for someone in your situation. Not the best product, not the cheapest product, just a suitable one. And among suitable products, they earn higher commissions for selling the ones the bank profits most from. The funds they recommend almost always carry expense ratios 5 to 10 times higher than index funds you could buy yourself. The retirement products they recommend frequently come with early exit penalties that lock your money up for 7 or 10 years, internal fees that are nearly impossible to calculate, and commissions paid to the salesperson that can reach 6 or 7% of what you put in. That commission is paid out of your money. Ask one question, a simple test. Ask the advisor, are you a fiduciary? Watch what happens. They will change the subject. They will talk about their experience, their certifications, the bank's commitment to clients. They will use the word trust. They will rarely give you a clean yes because the answer is almost always no. The branch is not where banks help you. It is where they sell you. The marble, the suit, the title, the chair, the language. Every detail is designed to make a sales pitch feel like a service. Chapter 9. The greatest loss of your life. Now we come to the one that makes every other deception in this video look small. Because everything I've told you so far has cost you hundreds, maybe a few $1,000s. This last one costs hundreds of thousands and almost no one notices. Because it is designed to look like help. The mortgage. When the bank quotes you a mortgage rate, 6%, 6.5%, whatever it is, that headline number is calculated to look good when competing against other banks' headline numbers. But the rate is just the entry point. The fees, the points, the structure, the spread, the amortization, that's where the bank actually makes its money. And the layers stack on top of each other in ways that most borrowers never decode. Layer 1. The difference between the interest rate and the annual percentage rate. The interest rate alone is just the interest rate. The annual percentage rate includes the fees the bank charges you to give you the loan. On a $300,000 mortgage with $9,000 in fees at 6.5%, the APR is closer to 6.8%. The bank quotes the rate because the rate is the smaller number. Every comparison you make based on rate alone is the comparison the bank wants you to make. Layer 2. Origination fees, discount points, and the buy-up trick. The origination fee is what the bank charges you for the privilege of giving you the loan, and it is largely profit margin. Discount points let you pay an upfront fee to lower your rate, and they sound like a deal. The problem is this. The break-even point on most points takes 7 or 8 years, and most homeowners sell or refinance before that time is up. You paid for a rate reduction, and you didn't stay in that loan long enough to recoup it. And here is the layer almost no borrower knows about. Lender credits. The bank can offer you a credit at closing, money that reduces your closing costs. It looks like a gift. It is not. A lender credit is a rate buy-up in reverse. They give you cash today. In exchange, you pay a higher interest rate for 30 years. On a $300,000 loan, a $2,000 lender credit can cost you $15,000 in extra interest over the life of the loan. They don't call it that. They call it a credit, because credit sounds like something you're receiving, not something you're paying for. Layer 3. The yield spread premium. When you go through a mortgage broker, the bank often pays the broker more for selling you a loan at a higher rate. The broker is incentivized not just to find you a loan, but to find you a slightly worse loan than the one you actually qualify for. That extra rate is not disclosed in a way most borrowers can decode. It is embedded in the offer. Layer 4. The amortization trap. On a 30-year fixed mortgage at 6.5% in the first year, more than roughly 80% of every monthly payment goes to interest, not principal. More than 80% of what you pay the bank in year 1 is the bank's revenue. 20% is your equity. The bank front-loads its profit by design. In that first year when the homeowner is savoring the joy of homeownership, celebrating finally paying down their house, nearly all of the monthly payments are flowing to the bank's balance sheet, not to their ownership. Layer 5. Total cost. Let's put it all together. On a $300,000 loan at 6.5% over 30 years, the borrower pays approximately $382,000 in interest alone. The house cost $300,000. The borrower pays a total of $682,000. The bank made $382,000 from a single customer on a single transaction, more than the house itself cost. And that's before the fees, before the points, before the spread. Every other deception in this video cost you hundreds of dollars. The mortgage cost you hundreds of thousands. And the entire structure is presented as helpful. We'll let you spread the cost, we'll give you a great rate, we'll work with you. What the bank is actually doing is structuring the largest single transfer of wealth most people will ever participate in, from your future self to their balance sheet, and dressing it up as a service. So what should you do? 3 things, quickly. 1. Move your savings out of your primary bank today. Opening a high-yield savings account at a separate institution earning 4% or more takes 10 minutes online. Every dollar you leave in a 0.01% account is a dollar you're handing the bank for free. 2. Read your fee schedule once. Set up balance alerts. Never overdraft again. The vast majority of overdraft fees in this country are paid by the same small group of customers, repeatedly, every month. The bank has modeled exactly who those people are. Don't be one of them. 3. Before you sign any mortgage, get quotes from at least 3 different lenders and compare APR, not rate. A 0.25%. APR difference on a $300,000 loan over 30 years is more than $15,000. The hour you spend shopping around is the best paid hour of your entire life. Thank you for watching this video. If this information added value for you, write in the comments which deception you found most shocking. For me, it's Chapter 4, Transaction Order Manipulation, because once you've seen it, you can never forget it. Like this video, share it, send it to your family and friends, because the more people this information reaches, the more money stays in your own pockets. And don't forget to subscribe to the channel because this series has only just begun. The bank is not your partner, it is your counterparty. The sooner you understand that, the sooner you stop losing money to it. They've been playing this game for 100 years. Now you know the rules.